Hello, and welcome to our video presentation on the 2024 CQA Investment Challenge. My name is Ryan Easley, representing Santa Clara University and Outlier Capital. And today, I'm joined by my fellow traders and analysts, Victor Hilt and Feng. First, we just want to say thank you for allowing us to participate in this year's competition, and we're very grateful for this fun but challenging experience. So first, getting into our investment philosophy, we believe that having a quantitative approach to investing in equities would ultimately surpass that of fundamental valuations and analyses. We believe that by training models on historical price data and volatility, that we can better predict risk-adjusted returns. Throughout the competition, our focus has been on generating portfolio alpha through short-term technical trading and utilizing Sharpe ratios to assess an equity's ability to provide risk-adjusted returns. We had a company-agnostic approach with a universe of over 5,000 stocks to choose from, and we acknowledge that there is a myriad of factors to consider beyond just traditional financial metrics. We believe that this approach ultimately would help us better capitalize on market inefficiencies because it's data-driven and backed by quantitative research. Now, getting into our investment approach throughout the rounds, for the first round, our strategy was to maintain a fully compliant portfolio while also maximizing our portfolio's net beta. We would achieve this by overweighting higher beta names and underweighting lower beta names. We do acknowledge that having a dollar-neutral portfolio inherently gives us a relatively beta-neutral portfolio. However, we did still try to maximize portfolio beta through the beta weighting of our positions. For the second round, we wanted to continue to maintain focus on portfolio compliance, but we also wanted to leverage up those positions that we believe to have higher expected returns. For the third round, we wanted to maintain our portfolio Sharpe ratio by trimming high-risk positions and also those positions that had decreasing expected returns. Now, speaking a little bit more to the actual construction of our portfolio, our core portfolio positions were selected by determining how well an equity delivers risk-adjusted returns. For example, a positive and increasing expected return was selected for a long, and a negative and decreasing expected return was selected for our shorts. And for the active risk positions in the portfolio, we would pursue high beta names with high expected returns to go long or low expected returns to go short. We would also participate in event-based trading post the event, such as corporate earnings, CPI reports, or Fed interest rate decisions. Any event that would ultimately invite market volatility or certainty, we would try to capitalize on. And now, speaking to our approach for actually selecting equities, we do acknowledge that our approach doesn't directly follow traditional Sharpe ratio uses, such as the annualization of a Sharpe ratio or using the Sharpe ratio at the portfolio level. But we do believe that by harnessing an equity's returns and its standard deviation, we can evaluate that underlying's ability to provide risk-adjusted returns. So first, we would calculate an asset Sharpe ratio for different timeframes. For example, consider a 4-hour Sharpe ratio over 200 days and a weekly Sharpe ratio over 20 weeks. So utilizing different timeframes as well as different periods to assess and analyze an asset Sharpe ratio. We would then utilize these Sharpe ratio values as well as their rates of change and input them into a regression model to help us predict the asset's log returns from historical data. We would also have other inputs such as the VIX to help determine systematic volatility beyond the asset's idiosyncratic volatility. And then we would finally determine what stocks to go long and short depending on the expected returns and trends in the Sharpe ratios. This will lead us to targeting assets with favorable return prospects and those equities that could actually deliver risk-adjusted returns. And here's the formula for the Sharpe ratio, which is the realized return of the asset minus the risk-free rate divided by the volatility of the asset. The risk-free rate would be dynamic depending on the period that we're assessing. However, we would still utilize the prevailing Fed funds rate at 5%. Victor and William will now dive a bit deeper into our portfolio and the analytics.
Ticker SMCI Supermicrocomputer Inc. is a core long position we've had in our portfolio, with 2 separate buy entries, one on January 17th and the other on February 21st. Our indicators of positive and increasing expected returns in regards to an appreciating rolling Sharpe ratios give us strong indication that there would be risk-adjusted returns that we see actioned in the performance of our holding from this graph. The same methodology and approach is applied to all of our long positions, with the inverse being true for our shorts. Our portfolio's zero demerits can be attributed to our compliance based on a rigorous rebalancing structure. We ensured that our portfolio was being monitored and rebalanced daily to ensure timely compliance, and we opted to have our portfolio's composition to be within 0.91 and 1.09 long-short ratio, despite the competition requirements being 0.9 and 1.1. Our trades and actions with this extra margin of error ensured we had no difficulty in the weighting of our portfolio. We also trade at a margin above the $5 price limit, also to ensure that we would not have unintended compliance violations. With our winning trades, we would begin to trim our positions to remain compliant with portfolio weighting protocols as needed. For our risk-based rebalancing, any position with a drawdown reaching negative 15% was sold to mitigate any behavioral bias that would hold on to any losers and sell potential winners early. Again, we would begin to trim our winning trades if we began to see expected returns decrease. As the competition wore on, we grew a decreasing risk tolerance to maintain and improve our portfolio Sharpe ratio. Regarding our portfolio performance, as of March 13th, 2024, we reached a competition return of 7.25% with a Sharpe ratio of 1.39. As the graph depicts, over the course of the competition, our strategy and investment philosophy grew tremendously, with very successful returns in February carrying into March, showing our commitment and ability to hone and best optimize our portfolio strategy and investment philosophy.
And here we take a look at our XMO risk report. It is important to highlight that our high-frequency trading approach influences our exposure to the risk factors in a non-typical way, which accounts for 63.44% of our strategy. We also may utilize our own property factors that are not accounted for by the risk factors. This insight is critical for fine-tuning our investment approach and optimizing for future opportunities. Our portfolio's nuanced performance is sharply outlined by our style factor analysis. It emphasizes our tactic embrace of individual equities for their risk-adjusted return potentials, aligning with our non-industry focused approach, as demonstrated by merely 11% industry exposure. Our dollar nutrition strategy is evident in our portfolio as a beta of 0.02. We specifically target high volatility and growth, aligning with our strategy's preference for high volatility environment and growth equities. Additionally, our portfolio's high market sensitivities is due to shorting forward 40 stocks, along with significant exposure to leverage and mid-cap sectors. Our sector analysis highlights both our strategic success and areas for improvement. We recognize missing opportunities in information technology and consumer discretionary sectors. Conversely, our decision to short consumer staples have proved advantageous, aligning with our market assessment. Additionally, our strategic exposure to real estate sectors has been measured and effective. This evaluation underscores the continuous need for adaptation and precise in our sector allocation strategy. For reflection, we have did a lot of preliminary background investigations, and we laid a solid foundation for more than 300 stocks for our choices. It is worth it. And our secret weapon for keeping our precision is to maintain the portfolio compliance at all times. We also adjust risk tolerance progressively as the event unfolds, aiming to achieve higher returns while maintaining a balance within a safer risk spectrum. The one thing we may regret a little bit is we paid a total commission of $22,000 due to more than 600 trades, which may be reduced, but it's worth the price for better and our more ambitious management. Our major loss is stemmed from the short positions because they are inherited and more challenging to focus compared to long position. The one thing we appreciate is the new limit of 1,000 trades. This allowed us the flexibilities to shift holdings without fear of overtrading. This slide contains all of our current long positions and the short position. The 5 companies on the left are the top 5 holdings we have, which all have returns of more than 50%. And this is the end of our presentation. Thank you for watching.